Hello, it's ChewDog Charts. Now today we're going to do something different. I'm going to have you do the work. I'm going to put up some charts, several charts, and you're going to do some critical thinking. Let's take a look. All right, to start off with, I'm going to show you two charts. The first chart here shows the year-over-year percentage change in personal income taxes collected by the federal government. And then I'm going to go toggle to a second chart, and that shows the year-over-year percentage change in corporate income taxes collected by the federal government. So here we have the first chart showing the personal current taxes. And you can see the low in mid-late 2009. Income taxes increased in 2010 into 2011, and then they've gone more or less sideways since probably late 2012. All right, now this next chart is the corporate taxes paid to the federal government. Somewhat similar in that the deep decline was in 2009 with a spike back in 2010, but the last few years have been going sideways, slightly negative in 2016. All right, let's go back to the first chart. Again, this is the personal taxes, personal income taxes. So, you, as a critical thinker, need to ponder this. How can the unemployment rate have fallen to levels last seen in 2007 if personal income taxes collected has been essentially flat for the last 2 years? Either the Bureau of Labor Statistics is lying to you, either unemployment rate or the jobs being added are nothing but burger flippers. So let's go look at the corporate taxes. Again, the spike in 2010, the last few years have been going essentially sideways. All right, the critical person is going to ask this question. If the stock market's at record highs because the economy is doing so well and corporations are rolling in dough, why have the corporate taxes collected by the federal government declined for the last 3 years? Let's go to our next charts. And then this chart here, which shows the equity positioning by investor type and as measured by percentile. And many of you can recall perhaps that I've shown this information in various forms in the past, so you may recognize some of this information. Taking a look here, you can see that margin debt, measured as a percentage of market capitalization, is at its highest point ever, which includes the 2000 tech bubble. The percentage of U.S. household wealth in equities is in its 94th percentile and above its 2007 peak, but slightly below the 2000 level. Sovereign wealth funds and U.S. mutual funds are also at near record levels. Pension fund allocations appear to be in the 88th percentile, although there is some uncertainty around this number, but it's pretty close. And then global hedge funds allocation, they're also at near record highs. And equity hedge funds allocation is in their 93rd percentile. So why does this matter? Well, because with everyone already long in stocks, there's basically no marginal buyer left to push the market much higher. Put another way, there's only so much that the market can rally if equity investors are already near their maximum allocations. Let's go to the next chart. And this chart, which is the results of a Bloomberg survey, the Consumer Comfort Survey of those unemployed. And basically, the unemployed respondents are telling Bloomberg that they're relatively comfortable. You got to go back to 2002 or prior to that to find a time period that they were even more comfortable, but the chart seems to be heading up. So the critical thinking person perhaps should ask, is that a good thing? Well, I don't think so. But I truly hope that the unemployed enjoy their holidays. And then a quick series of charts. This chart here is the number of months until the first negative total return month in a calendar year. And as you can see on the very far side, the very right side, the green bar. And essentially, it's been about 12 going on 13 months since we've had a negative return on a calendar month. That's an absolute record going back to 1928. And this chart here shows the S&P 500 versus the treasuries, the 2-year and the 30-year yield curve. We see that the yield curve continues to flattening. Now, we're not necessarily at a significant level yet, but we're fast approaching that flattening of the yield curve, and perhaps there's going to be an inversion. So we'll keep an eye on that. The critical thinker should be thinking, what's going to happen next and what's the impact on the stock market, and we've covered that before, so you know where I'm going to be on that one. And then this last chart, which shows the increase in the value of the small caps versus the 2017 earnings per share expectations. And as this chart shows, they're going in opposite directions. The critical thinker is going to ponder whether that's a good thing or not. And let's go to our last segment. And lastly, we find ourselves at Long Blockchain Corp. Long Blockchain Corp used to be known as Long Island IT Corp. However, it changed its name to Long Blockchain Corp. It used to make non-alcoholic lemonades and iced teas, and as of Wednesday, the company had a market value of $23.8 million. But following the name change and a day of trading, it was up about 275% to a market value close to $138 million. It was all based on a name change. So the critical thinker is going to have to ponder the question, are we in a bubble? Well, that's it for ChewDog Charts. I thank you.